Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss how research and development spending do not predict the performance of stocks.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. Today I would like to discuss research and development or innovation premium. What does it mean? In the current situation, most of the people think that stocks that highly innovate like Apple or tech stocks should outperform their peers that do not invest so much money into research and development. The question is, does this idea really holds? So does it mean stocks that invest a lot into research and development, do they really outperform their peers? So what we did around 1 or 2 years ago is that we identified a few papers that were discussing different research and development strategies, and we did a rigorous testing of those papers and those strategies, and I will show you what are the results. So when I'm talking about analysis, I'm talking about the article and investigation of research and development premium strategies that's on our blog, on Quantpedia's blog. So we identified 3 interesting papers that deals with research and development premium. So the first paper is written by Lauren Cohen and his team. In this paper, author it's from 2012. Author shows that there is a benefit if the research and development expenditures are translated into real research development success. So what does it mean? This author built a special indicator in which he measured how much money that was spent on research development was translated into increase in the sales, and then he sorted stocks based on this measure, and he went long stocks with the best measure. So we tried to replicate the strategy. What are the results? Now, the results from the auto sample test, we ran data from 2011 until 2020 were not so great as in a paper that was written in 2012. What we found out is that the strategy is working only in a technology healthcare sector. So those 2 sectors are the only sectors in which it really makes sense to implement the strategy. So those are the sectors in which when you buy the companies that invest a lot into research development and then translate a lot of those money spent into the increase in the sales. When you buy those companies, you really outperform the peers. In all of the other sectors, it was not working. A result of the whole testing was that in the whole cross-section, the measure that was selected in the paper is not able to predict the future returns in the cross-section of all US stocks. So it's only working in a few sectors in healthcare and technology. Then we tried to revisit the paper number 2. It was written by Louis Chen and his team in 1999. This paper is significantly easier, so it means instead of measuring what is the success of development, etc., the authors just considered a simple measure. So they just related the amount of firms' research development spending to the actual sales. So what is the percentage of total sales or total assets that is used for research and development, and then they sorted stocks based on that. So the idea is that the stocks that invest a lot without any check what is the success, stocks that invest the most should outperform their peers. Once again, we tried to replicate the results. So the performance of this simple strategy was better than in the previous case. So we were able to replicate results successfully, but then we tried to do the filtering for the sectors. So we checked what is the performance inside the sectors, and out of 11 known market sectors, only technology, healthcare, and communication services sectors were relevant. They were outperformed, so the stocks from these sectors outperformed the peers when they invested a lot into research development. And then there is another conclusion. So we try to build a sector neutral investment universe, and the positive returns vanished. So what does it mean? We must conclude that the primary source of the strategy is positive return, not research development premium, but rather some economic forces, most probably the sector exposure. So what does it mean is that when we sort all of the stocks and we select those that have the highest research and development spending, we are picking the stocks from healthcare and technology sectors, and those sectors outperform other sectors. So the performance of the strategy is caused by sector exposure and not by research and development premium. So once again, not very satisfactory result. Now, when we move to paper number 3, which was written by Lin Yu et al. And his team in 2018, once again, this research paper employs a similar logic and methodology as the previous paper. In this paper, the authors are directly sorting the portfolio into so-called high-tech and low-tech stocks based on the industry codes, and then they use the research development spending and try to predict how the stocks will perform. So once again, when we did the replication and we add the high tech and low tech and we measured the research and development expenditures, what we have found out is that basically the strategy goes long high tech stocks and short low tech stocks, and in this case we can have some outperformance, but it's not because of we are investing into high research development stocks, but because we are investing into technology and cost stocks. Once again, it's a sector exposure that drives the performance and not the research and development strategy. And that's the conclusion of all three backtests that we had, all of the different measures that we tried. What is the result? Once again, it's not about how much is the company spending on research development. Research development stocks perform well because technology stocks performed well. The period that we backtested, so it was approximately from 2010 until 2020, or from 2000 until 2020. The research development premium is driven completely by sector exposure. In the case there is a sector rotation or some shift in a macroeconomic situation, this research development premium will completely vanish probably. This shift is happening at the moment when the inflation is higher, the interest rates go higher, and we have a stocks that really do not perform very well, and it's probably the case also with the research development premium. So once again, take care of really test strategies well in the past. And it's very important to understand what is the underlying force that drives the performance of any anomaly, because it doesn't have to be really the performance of the premium or the premium from the factor. It can be hidden sector exposure or some hidden exposure on interest rates or inflation. And once the macroeconomic regime changes in the future, your strategy can stop working. So thank you very much for your attention, and I hope that you liked this video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.